Interest rates have you feeling like you're dreaming of owning a home is slipping further and further away. Don't let the headlines scare you. It's not the end of your home buying journey. In fact, I've helped many first time home buyers navigate high interest markets, and guess what? They're still thriving as homeowners. If you're ready to take control of your future, stick around. I've got the tools and tips to help you buy your first home without losing sleep.
The headlines say mortgage rates are still high. Your dream says buy now. Your budget says not yet. Every week you watch another listing creep out of reach. You are not imagining the squeeze, but you are also not powerless. This film is your plan to buy your first home in 2025 without wrecking your cash flow. We will use the same structure we apply to every serious decision in the economics of living. First, the economic reality you cannot control. Second, the social and life patterns that shape what actually works. Third, the housing tactics you can act on today. We will move from fear to a framework, from headlines to math, from window shopping to a signed key that fits your life. Here is the truth you need on page 1. You do not have to beat the interest rate. You only have to beat the total monthly cost that would beat you. That is the job. We will show you how in 6 parts. Each part ends with a checklist and a move you can make before the weekend. When you finish, you will have a guardrail, a lender playbook, a negotiation script, a product map, a house hacking module, and a location pivot that turns high rates into solvable math.
Hey there, I'm Justin Smith, JPAR Rockwell, your local real estate expert here in North Texas. I know the market looks intimidating right now, especially for first-time home buyers. I'm talking to you. But I've seen markets like this before, and I'm here to tell you that even with higher interest rates, buying your first home is not only possible, it's still a great idea. So today I'm breaking down the strategies that can help you turn today's challenges into opportunities. So grab a coffee, settle in, and let's talk about how to make your dream of home ownership a reality. Let me get those words out. So the key point number 1 that you need to understand is understanding the interest rates. Let's start by addressing the elephant in the room.
The economic lens. Rates are the weather. You cannot set the weather, but you can build a house that does not leak. The way to do that is to underwrite yourself before anyone else does. Use a stress-tested budget that assumes your worst plausible month, not your best. Add the true cost stack: mortgage principal and interest, property taxes, homeowner insurance, mortgage insurance if required, HOA or condo fees if applicable, utilities, maintenance reserve, commuting costs. That is your real monthly. The social lens. Most first-time buyers fail not because of the interest rate, but because they did not plan for the total month or the first-year cash that homeownership demands. They underestimated the non-glamorous numbers: utility spikes in summer or winter, the first deep repair, the commute that eats fuel, the HOA rule that adds a fee. The fix is to price the whole life, not just the house. The housing lens. Lenders will approve you to a limit. That limit can be higher than your safe guardrail. Do not confuse approval with affordability. Set your own cap. Here is a reliable framework. 1. Set a hard housing cap at 30% of gross income. If you carry meaningful debt or you face childcare costs, aim for 25 to 28%. To build a maintenance reserve into the monthly, 1% of home value per year is a conservative rule. 0.5% can work in a newer home, but you must still plan. 3. Stress test the payment at 1 percentage point higher than today for safety. If you can survive that number with savings left over, you can live with the real number today. Practical checklist. Calculate the full monthly including taxes, insurance, HOA, utilities, a maintenance reserve, and commuting. Stress test principal and interest at a rate 1 percentage point above your quoted rate. Set a minimum 3-month housing reserve in cash after closing. Keep your total debt to income under your own cap, not the bank's maximum. A move you can make before the weekend. Download 3 recent electric and gas bills from a similar home type in the same zip code. If possible, if you are touring a listing, ask the listing agent to request 12-month utility averages from the seller. Add those to your sample monthly. If that total breaks your guardrail, move your search or change the property type before you fall in love. The economic lens. High rates punish the unprepared and reward the organized. Rate is only one lever. Price, points, credits, buydowns, and timing all shape the effective cost of money. Your job is to turn a hard rate into a softer monthly by choosing the right structure and by negotiating who pays for it. The social lens. Most buyers shop homes harder than they shop money. That is backward. A 1% improvement in your financing structure often saves more money than a $5,000 price cut. In 2025, you must be a ruthless shopper of money. The housing lens. There are 5 tools you can combine. Tool 1. Shop lenders the right way. Request standardized quotes that include interest rate, APR, points paid, lender fees, and a rate lock policy. Ask each lender for a written break-even on points. Get at least 3 independent quotes. Consider a credit union, a mortgage broker, and a direct lender for a fair spread. Tool to use a float-down rate lock when available. Lock when you have a home under contract and ask for a float-down option. That lets you capture a lower rate if the market drops before closing. Get the policy terms in writing. Tool 3. Decide between a permanent buydown and a temporary buydown. A permanent buydown uses points paid upfront to reduce the rate for the life of the loan. The math is worth it when you expect to hold the loan long enough to pass the points break-even. A temporary buydown, such as a 2-1 or 1-0, reduces the rate in year 1 or years 1 and 2, then steps up. This can be ideal if you expect income growth or a refinance window within 2 to 3 years. And if you do not overstretch, always negotiate to have the seller or builder fund the buydown with a closing cost credit. In many markets, sellers prefer to fund a buydown rather than cut the headline price. You are trading psychology for math. Tool for use. Split mortgage insurance if you are putting less than 20% down. A small upfront ME payment plus a lower monthly ME can beat standard monthly ME. It also reduces the monthly, which matters more than a slightly lower cash to close if your payment is tight. Tool 5. Work the season. Late fall and winter tend to be softer in many markets. If you are close to ready, align your search with a slower season to increase your leverage for seller credits that fund your buydown. Practical checklist. Get 3 lender quotes with identical assumptions, same price, down payment, and lock period. Ask for a written points break-even timeline for each quote. Price a seller-funded temporary buydown and a permanent points buydown side by side. Ask about float-down rules in the rate lock. If putting less than 20% down, price monthly ME versus split ME versus lender paid ME. Schedule your offers around the softest month you can realistically target. A move you can make before the weekend. Write to short scripts and rehearse them. For the seller credit script, if we can agree on price, would you apply X at closing toward a 2-1 buydown with my lender so the payment fits and we close faster? For the lender script, please quote me 2 options with identical terms except for buydown structure, first with 2 points and no buydown, second with 0 points, and a 2-1 buydown funded by a 3% seller credit. Show the effective monthly each year. I need a written break-even. The economic lens. In a high-rate year, the wrong product costs more than the high rate. Your goal is to match loan type to your timeline and your risk tolerance. The social lens. First-time buyers often over-focus on the down payment percentage and under-focus on the product rules that shape monthly cost and future flexibility. You need a clean map of options. The housing lens. Option 1. Conventional with 3 to 5% down. Strong for borrowers with solid credit and stable income. ME can be canceled as you hit 20% equity. Split ME can lower the monthly. Option 2. FHA with 3.5% down. More forgiving credit box and debt to income. Strong for early career borrowers or those rebuilding credit. MI is upfront plus monthly and remains for the life of the loan, unless you refinance out of FHA later. FHA is also a gateway to house hacking data for units with low down. Option 3. VA 0 down for eligible veterans and service members. Often the best monthly cost in America when available. No monthly ME. Funding fee rules apply. Powerful when combined with a buy-down paid by seller or builder. Option for USDA zero down in eligible rural areas with income limits. Excellent for buyers who qualify and want to live within the map. Option 5 state and local housing finance agency programs. These can layer down payment assistance, closing cost grants, or below market rate seconds. The strings matter: repayment triggers, recapture, second lien rules. But the math can open the door. Option 6 adjustable rate mortgages with safe caps and a disciplined refinancing plan. In a high-rate environment, a well-structured ARM with a long fixed period and tight caps can lower the starting payment. Only use ARMs you fully understand. Write the refinance rule before you sign, and only if you can still afford the fully indexed cap number. Option 7 assumable mortgages. Many existing FHA and VA loans from the low rate years are assumable by qualified buyers with lender and servicer approval. You take over the seller's low rate and payment and bring cash or a second lien for the difference between their balance and your price. This is one of the most underused strategies in 2025. It requires patience and a listing willing to cooperate, but the payoff can be dramatic. Practical checklist. Pull a full tri-merge credit report and fix errors 60 to 90 days before pre-approval. Price conventional 5% down with monthly me, split me, and lender paid me. Price FHA 3.5% down side by side. If eligible, price VA zero down with a 2-1 buy down funded by a seller credit. Check USDA eligibility maps for your target counties. Ask your agent to search for assumable FHA VA listings and to add an assumption rider to your offer. When you find a match, if you consider an ARM, write the worst case cap payment into your budget. If you cannot survive that payment on your current income, do not do the ARM, a move you can make before the weekend. Call your state housing agency or visit their site to list active down payment assistance and first mortgage programs. Write to stacks for yourself a no assistance stack and an assistance stack. If the assistance stack adds complexity you cannot manage, return to the cleanest conventional or FHA route and fund your own closing with a seller credit. The economic lens. When mortgage rates are high, builders have a problem. They need sales velocity to keep crews working and keep lending covenants happy. That problem can be your opportunity if you approach it like a pro. The social lens. Buyers love model homes and forget the math. Builders love clean closings and will trade money to get them. Your objective is to convert that trade into a lower monthly, not just a free fridge. The housing lens. Target inventory units, quick move-ins, and homes that are near completion. Those are the homes most likely to receive real incentives. Builders often prefer to spend money on rate buydowns through a preferred lender because that is how they maximize perceived value. You can use a preferred lender quote as leverage and still compare it with an outside lender. Make the builder's money work for you. Negotiate for credits that reduce your monthly first. Priority 1 a seller funded to 1 or 1-0 buy down. Priority to permanent points paid by the builder to lower your APR. Priority 3 closing cost credits that reduce your cash to close, if and only if the monthly is already where you need it. Priority for tangible long life upgrades that reduce future maintenance, or utilities such as insulation, windows, or VIC quality. Inspect like a realist. Even a new home can arrive with issues. Hire your own inspector. Walk the home at framing if allowed, then again before closing. Get the warranty in writing and know exactly how to file claims. A small list of blue tape items is normal. A major system defect is not. Practical checklist. Make a list of all builders in your target zip codes building homes under your price ceiling. Ask each sales office which quick move-ins are eligible for incentives this month. Collect preferred lender quotes and ask for the exact credit amount the builder will apply to your loan. Price the same home with an outside lender using the builder credit as seller paid points. Prioritize monthly lowering incentives over cosmetic gifts. Schedule independent inspections and a final blue tape walkthrough. A move you can make before the weekend. Drive 3 new communities that match your price bracket. Ask a single question at each office. What is the biggest credit you have offered in the last 30 days on a quick move-in? And can I apply it to a 2-1 buy-down instead of options if the answer is vague? That community is probably not your best leverage. The economic lens. When rates are high, the winner is not always the lowest price home. It is the home with the most flexible income options that are legal and stable. House hacking is not a trend. It is an old idea with new tools. The social lens. Many first-time buyers are one decision away from affordability. A roommate, an accessory dwelling unit, or a two-for-unit property you live in for a year can flip the math from no to yes. The key is to follow the rules and to underwrite the income conservatively. The housing lens. Option 1, live with a roommate and write the lease. If your loan program allows border income or if you plan to refinance later, a written lease helps your file and your future. Option 2, buy a 2-for-unit with FHA. Live in one unit, rent the others. Use legally allowed projected rent as qualifying income per program guidelines. This can be the fastest way from renter to owner if you have the tolerance to be a small landlord. Option 3, find a property with an ADU or a space you can convert legally to an ADU. Check zoning and permitting first. Option 4, target a home with a separate basement or above garage suite. Long-term renters are more stable than short-term rentals and often friendlier to your loan program. Underwrite conservatively. Use 75% of projected rent for planning, not 100%. Leave a 1-month vacancy and repair reserve in your annual cash flow. Know the local rules on leases, registration, and licensing. Practical checklist. Confirm which loan types in your state allow it to for units with low down payments and how they treat projected rent. Price the same property as an owner-occupied 2-unit and as a single family with a roommate. Check zoning for ADS and registration rules for rentals by address. Write a sample roommate agreement and a sample lease. Add 1 month of vacancy and a repair reserve to your first-year cash plan. A move you can make before the weekend. Search for properties with the keywords basement apartment, in-law suite, ADU, duplex, triplex, fourplex within your budget. Tour 2 of them and ask for actual rent rolls or recent leases. If the numbers pencil with a 25% haircut to rents, keep moving. If they only work at perfect occupancy, pass. The economic lens. High rate years expose the difference between price and value. Markets tend to misprice 3 things at the same time: smaller homes, older but solid homes with light cosmetic needs, and overlooked geographies that commute better than their reputation. The social lens. Most buyers chase the same neighborhoods, the same floor plans, and the same photo-ready finishes. You are going to win by stepping to the side. The housing lens. Work the 5 pivots. Pivot 1, radius and corridor. Expand your search radius along a highway or transit line that preserves a good commute. A 15-minute shift on the map can be a $150,000 shift in price. Pivot to product type. Condos and townhomes can deliver location, safety, and convenience with a lower entry price. Compare HOA dues to the true cost of yard care, roof, and exterior maintenance on a detached home. If the HOA covers big-ticket items, the monthly can still win. Pivot 3, small and smart. A smaller, well-laid-out home is not a compromise if it reduces your payment by hundreds. Track price per square foot and utility savings. Your life gets bigger when your monthly gets smaller. Pivot for Fixer Light. Paint, floors, and fixtures can transform a home without structural risk. Price the work with 2 bids before you offer. Ask for a seller credit to fund it. Move in and improve as you live, not all at once. Pivot 5 Energy. An older home with good insulation and a modern HVAC can beat a newer home with poor envelopes. Utility bills matter as much as countertop material. Practical checklist. Draw 3 commute corridors that take you to work or your most important daily place in under 45 minutes. Add to property types you had not considered: townhouse, small condo, or a modest single family with an ADU. Write a Fixer Light scope: paint, floor, lighting, and a rough budget per square foot. Collect 12-month utility histories during tours. Rank candidates by effective monthly, not just price. A move you can make before the weekend. Tour 2 homes that are 10 to 15 minutes outside your original boundary. Bring a tape measure. Can your life fit here with a smaller footprint? If the answer is yes, and the monthly is hundreds lower, that is your sign. Week 1 to clean your credit and underwrite yourself. Pull your credit, fix errors, pay down revolving balances to under 30% utilization, and freeze any buy now pay later accounts that confuse underwriting. Build your full monthly with taxes, insurance, HOA, utilities, a maintenance reserve, and commuting. Set your cap and stress test it at a rate 1 percentage point higher than your quotes. Week 3 to for shop money like a professional. Collect 3 lender quotes with identical assumptions. Ask for rate, APR, points, lender fees, mortgage insurance structure, and lock policies. Price permanent points versus a seller-funded temporary buydown. Ask for a written points break-even. Choose a lender for pre-approval and keep 2 as backups. Week 5 to 6, pick the product and the plays. Decide your loan type with eyes open: conventional, FHA, VA, USDA, or a state program. Confirm whether an ARM with safe caps fits your risk tolerance, or if a fixed rate is the only acceptable path. Ask your agent to search for assumable FHA VA listings. Write your seller credit script and your lender buydown script. Week 7 to 8, hunt the mispriced inventory. Target quick move-in new builds, stale listings with 60+ days on market, and Fixer Lights that need paint and floors but not structural work. Tour with your utility and repair checklists. Collect utility histories and to repair bids. Week 9 to 10, make the math move. Write your first offer with a seller credit for a 2-1 buydown or for permanent points. Not just a price cut. Add inspection contingencies and appraisal strategies that cap your exposure. Lock with a float down if available. Schedule independent inspections and the final blue tape for new construction. Week 11 to 12, land the plane. Review the closing disclosure line by line. Confirm that credits are applied correctly, the buydown is funded as agreed, and you still have a 3-month housing reserve after closing. Move in slowly. Tackle Fixer Light projects in the right order: safety, leaks, utilities, then beauty. Celebrate the first night with takeout and a quiet walk around the block you now call home. If you remember only one sentence, remember this: you do not have to beat the interest rate. You have to build a structure that beats a bad monthly. Underwrite yourself. Shop the money. Make the seller fund the buydown. Choose the loan that fits your life. Hack the income if you need to. Buy what the market misprices. Do these 6 things and a high-rate year becomes the year you bought well. Print the checklists. Rehearse the scripts. Walk through the door that math opens. Then exhale. The market can keep shouting. Your monthly will be quiet.